Hey friends, Lucian here with the Bullish Bears team. Wanted to make this video on call spreads and what they are. There are a lot of different option strategies that are out there on the market. So we have a couple courses that will help you on our website at bullishbears.com. The link will be below, but this video is going to be specifically on call spreads only. So if you want to know the other strategies, make sure you take our courses on our website. So spreads in general consist of buying and selling options on the same underlying asset, but at different strike prices. I'll show you an example of this towards the end of the video. Again, if you're not sure what strike prices are and all of that, what calls and puts, you definitely need to take our courses to learn about this. But they typically, with call spreads, have the same expiration, but they could be different depending on your strategy that you're employing. Spreads in general consist of calls or puts, not both. So if you're doing a basic call or put spread, you're doing, again, calls or puts. You're not doing a combination of both when you're doing a basic option spread. And it consists of the same number of long and short options. So an example would be, let's say you're buying one ABC short call with a strike price of $100 that expires in 40 days. Then you would buy one ABC long call with a strike price of 105 that expires in 40 days. So the difference in that example is just the strike price itself. So you'll see you're not buying multiple, you're not buying, let's say, two short calls, one long call, or one short call, or two or three long calls. In this strategy, you're buying, again, 1 and 1, 2 and 2, 3 and 3, 5 and 5, 10 and 10. Whatever they're just equal the number of contracts on both sides. Now, again, there are many different assortment of spreads. There's vertical spreads, horizontal, diagonal, credit, debit, bull spreads, etc. But the most basic is the vertical spread. Now, vertical spreads are directional, so you profit on price movement. So you want to look for the direction, whether you're bullish or whether you're bearish. You're profiting on the actual directional movement of the underlying stock. Now, your risk and profit levels are defined, so this is a good thing. Remember, naked options are risky. Not saying to not trade them, but again, there's different strategies, depending on what type of trader that you are. So naked options, you could lose, if you're just being an options buyer, let's say, and you're going naked, you could lose all your money on that trade if you get the direction wrong. If you're an option seller going naked and the price goes against you, you could lose a lot of money as well. So not saying to not go naked, but you just have to employ the proper strategy behind it. Now, with call spreads, again, this video is only on call spreads, they consist only of calls, not of puts. And they're the same number, both bought and sold. And it's a great strategy to profit in any type of market, which I will explain in a moment with some examples. So again, some of the different examples of call spreads are the bull vertical call spread, bear vertical call spread, horizontal calendar call spread, neutral calendar call spread, bull calendar call spread, and also the diagonal call spread. So I'm just going to talk about two of the most basic ones right now, which is the bull call or debit spread. And this is what you would employ if you believe the price of the stock is going to go up at expiration. And again, depending on your strategy, there's so many different ways to construct them, but you're buying typically either at, in, or near the price. So you're an options buyer, and then you're selling typically a call. So you're buying a call at, in, or near price, and then you're selling a call out of the money, right? So with a bear call or a credit spread, you believe the price is going to fall before expiration. So this is where you become an options seller. So you're selling at, in, or near price a call, and you're buying an out of the money call. So with a bull call or a debit spread, you're an options buyer, or a bear call or a credit spread, you're an options seller. So just to kind of give you an example of how this looks, again, it can be tricky with all the different names too, because there's several different names to options as well, so it can get a little bit confusing. But just to kind of show you here, back in the back of this is Thinkorswim right now, you can see right over here, let's say we'll do a debit spread first or a bull call. This is where you can just say right click on the ask buy, go to vertical, and you'll see when I construct it here, you'll see my primary right here. I clicked on the 155. This is kind of, this one's basically at the money, right? And you'll see there's one out to the money, right? So this is consisting of buying a call in or at the money and then selling one out of the money. So you'll see when I confirm and send it right here, you'll see this is a max. It's showing right here your max profit and loss. And then obviously the further I go out, again, price will go up more. So let's say I bought one at 155, sold one at 160. You'll see the price goes up, max profit, max loss. So that's how you adjust it. But again, just to kind of show you here, if you're kind of confused, you can see it says call debit. So bull call is actually a call debit spread. I know it's confusing with the multiple names, but welcome to the world of options. If you're new, it gets confusing where there's multiple names for the same thing. So that's what, again, a bull call or a call debit spread looks like. Let's look at the opposite, which will be a bear call or call credit spread. So this is where you go to the opposite side, and let's say we'll do a, same thing right here. We'll just do selling a, we're going to sell vertical right here. So this is now a call credit spread, right? So we're selling right at here at the 155. And then we're buying down right over here, one out of the money. So you'll see when I confirm and send, this is giving you, it is a credit spread. So you're receiving money in, and when you're doing a debit spread, you're putting the money out up front. So you'll see right here, max profit, max loss. Again, we go over all this stuff in our courses. This is just kind of a highlight video on call spreads, but just to kind of show you the difference of one's being an options buyer, the other's being an options seller. So with a debit spread, you're putting the money out up first, so you're being an options buyer. Again, the odds are not in your favor as a buyer, which doesn't mean you don't do them. It's just a different trading style. So you're putting the money out up front, so there's more reward. But on a credit spread, you're receiving the money coming in, so there's less reward, but the odds are more in your favor because trading odds are in your favor being more as an options seller. Again, doesn't mean you're not doing naked at times. Each strategy is different when you're trading options. So if you're new, I know trading options or the concept of options can be very confusing. It does take some time to learn, but don't worry, we have some courses on our website to help you over at bullishbears.com. The link will be below. We have a couple options courses to really help you get started. And we also have trade rooms as well that teach you, options, swing trading. We also teach penny stocks, futures, and all of that good stuff. So you can give us a try over at bullishbears.com. And as always, if you like this video, we would greatly appreciate it if you give us a thumbs up, subscribe to our channel, and share this video out on social media. So hopefully this video helped you, and we'll see you in our community. Enjoy.